Hey guys, hope you're doing well out there. Today we're taking a look at the 5 most important metrics that I use to analyze and value a stock. If you're just starting out with investing in the market, there's a lot of terminology thrown around there on YouTube, on CNBC, even here on the channel. We talk about a lot of these terms like a price to book, price to sales ratios, cash flows, and all of that can get quite confusing. And so in this video, I'll start off by sharing why you should even care about these and how to use them. Then we'll break down the 5 must-know metrics that I use to study companies to invest in, how you can calculate them, and also where you can look to find them on a site like Seeking Alpha. If you're new to investing or you've been doing this for a while, it's super important to just constantly level up your game so you can continue to do this at a high level for a long time. Look, you have to continue to grow as an investor. And so if you get any value out of this video, all I ask from you is to hit that like button. It really helps put the video out to others. Subscribe if you're new here. And with that, let's start off by looking at the 3 things you should know about stock metrics as a whole. Now, the first thing is the concept of qualitative versus quantitative analysis. And so when researching a company, you should analyze it both on a qualitative and quantitative basis. So what do I mean by qualitative analysis? You've probably heard this term thrown around quite a bit. So qualitative pieces include things like market research, understanding the industry, knowing who the competitors and peers are, what is the track record of the management team, and what is the brand strength. Things like that essentially just boils down to understanding the business. If you understand the business, you're kind of taking a look at the qualitative piece of it as a whole. On the other hand, we have the quantitative piece, which includes things like revenues and costs, cash flows, margins and assets, liabilities, and a lot of those things we like to focus here on the channel. It also includes the future prediction on growth rates and earnings, and of course it includes the topic of this video, which is valuation metrics. And so all of that was to say that these metrics that we'll discuss are just one part of a larger deep dive you have to do when you're investing in a company. It includes both the qualitative and quantitative piece, and today we're just taking a look at one part of that quantitative piece. Now, the second super important piece you have to consider when looking at these metrics is that they're most useful when comparing companies in a similar industry against each other. Look, we all have a limited amount of money to invest, and we need some way to determine why one company is more investable than another. And stock metrics or valuation metrics help us do just that. Now, the last and final piece you have to remember is the concept of forward versus trailing. And you hear this in the markets quite a bit. You might hear someone say forward PE or trailing PE, or similarly forward price to sales or trailing price to sales. And in that case, forward just means the metric is calculated by looking at the next 12 months based on estimates made by analysts, while trailing looks at the past 12 months of numbers the company actually reported. And so that's all it means. Forward looks at the next 12 months, trailing looks at the previous 12 months. But you'll hear that a lot. We'll even cover that in this video. And so wanted to get that out of the way. So with that out of the way, let's jump into the 5 metrics you must know as an investor. First up, we have the price to sales ratio. And so the price to sales ratio is the value the markets give to each dollar of the company's sales, or in other words, how much are investors willing to pay per dollar of revenue generated. And so a price to sales ratio of exactly 1 means that investors are willing to pay exactly $1 for every $1 of revenue generated. In my opinion, that seems pretty logical, but you can also have the price to sales be under 1 if investors are willing to pay less, and more often than not, you can have the ratio be over 1 if investors are willing to pay more per dollar of revenue. Now, you might ask, why would someone pay more than $1 for every $1 of revenue generated? And that could really come down to a lot of factors, but the 2 most important factors, in my opinion, are revenue growth and gross margin. And to put that into perspective, let's use an example. So if 2 companies have the same revenue figure today, let's say $10, just for simplicity, but company A is growing revenues at 50%, while company B is growing revenues at 10%, every dollar of revenue company A generates should be worth more today since it's compounding at a faster rate. And so in that case, company A would demand, theoretically at least, a higher price to sales ratio. Now, in the other case, let's say company B has gross margins of 50%, but company A has gross margins of 10%. Every dollar of revenue company B generates goes further since it was cheaper to generate. And so in that case, company B would demand a higher price to sales ratio. And so those were just 2 examples of why revenue growth and the margins a company generates would matter when considering a price to sales ratio. And so keep in mind, like all valuation metrics, this best fits when comparing companies in a similar industry against each other. We can also calculate the price to sales ratio by taking the market cap and dividing that by the company's sales. So to really break this down, let's take a look at the example of Visa. If you go to Seeking Alpha, search for Visa, and you go under the Valuation tab, you can look at Visa's forward price to sales and trailing 12-month price to sales here on the left-hand side. So on its last 12 months, Visa is trading close to a 17 times price to sales, and on a forward basis, close to around 15.5 times. And you can also compare that historically against Visa's own average over the last 5 years. And you can see this company does trade extremely rich on a price to sales ratio, and so that for that reason, that's actually why I took this example for Visa, and that's mainly because it has such high gross margins. With nearly 90% gross margins, investors are willing to pay close to $17 for every $1 Visa generates in revenues, simply because it's such a high margin business. A lot of that top line dollar will flow right down to the bottom line, and so for that reason, Visa does trade at a pretty expensive price to sales ratio. Now, on its own, it really doesn't mean anything, and so we would have to compare it against one of its peers, in this case MasterCard. You come to the same valuation tab for MasterCard, and you see on a trailing 12-month basis trades close to an 18 times price to sales ratio, and then on a forward basis, meaning you take a look at the next 12 months of expected sales, it's trading closer to 16 times. Again, over its last 5-year average is slightly lower. And so from this, you can compare Visa and MasterCard and see that MasterCard tends to generally trade just a little bit marginally higher on a price to sales ratio compared to Visa. The other important thing to look at is the fact that the forward price to sales is lower than the trailing 12-month price to sales. And really what that means is over the next 12 months, MasterCard and similarly Visa is expected to generate more in revenue in the next 12 months than they did over the previous 12 months. And so whenever you take a look at an investment, you want to see a price to sales ratio that is declining as you're looking ahead, which would mean that the revenues are expected to grow in the future. Now, similarly on Seeking Alpha, you can also compare them on a chart basis. So you can pull up the chart for both of these companies and really any other companies you want to compare, pull up the price to sales over the last 12 months, and you can see both these companies relatively like to trade in line to each other, don't really deviate too much from each other. And in fact, anytime they do deviate quite a bit, that's probably an opportunity you have to identify one might be undervalued or overvalued compared to the other. And so over the last 5 years, these companies like to trade relatively in line and relatively expensive compared to other industries, simply because of that extreme high gross margin. And so the price to sales is an extremely important metric to consider. It really tells you the overall story of the top line dollar and what investors are willing to value that in the market. Now, the next must-know metric, I think, for all investors is the debt to equity ratio. This really tells us how leveraged a company is, or in other words, how reliant it is on the debt that it holds. Debt naturally is a pretty risky thing, and so you want a lower debt to equity ratio, as that's going to indicate the company has a lower risk of defaulting on a loan or even undergoing possible bankruptcy. So you take the total liabilities, divide that by your total equity in order to get your debt to equity ratio. Now, usually the lower the ratio, the better, but that's not always the case. Let's say interest rates are really low at a time and debt is relatively cheap. Using that debt to grow faster may not necessarily be a bad thing. And then the other case is when a company has a negative debt to equity ratio. That would mean that it has negative total equity, which would mean it has more total liabilities than total assets, because equity is just your assets minus your liabilities, and that would be a big red flag and show signs of a possible bankruptcy. And so we ideally want to hold companies with a debt to equity ratio that's under 2. For an example, let's take a look at Alphabet, otherwise known as Google's debt to equity ratio. If you go on Seeking Alpha, underneath the financials tab, you go to the balance sheet and you take a look at the 2 line items, total liabilities and total common equity. In the case of Google, and really in the case of a lot of software companies or a lot of tech companies, you have a very good debt to equity ratio simply because they don't need a lot of debt to expand or grow rapidly. And so there's really no reason for them to take out a ton of debt. In the case of Google, they're sitting on roughly $119 billion of total liabilities, which is balanced out by roughly $283 billion of total equity. And so you take the numerator, divide that by 283, you get to a debt to equity ratio of right around 0.42. Again, we were looking at debt to equity ratios underneath 2 as really attractive. And so in this case, Google sitting at a very nice debt to equity ratio. Similarly, we can take a look at Meta Platforms or Facebook. Similar debt to equity ratio at right around 0.5 with just $76 billion in total liabilities and $153 billion in common equity. But this is not always the case with all tech companies. And so we can take a look at Oracle, for example. This is a company with a debt to equity ratio of right around 21 times. that is a massive debt to equity ratio, simply because they've in the past taken on a ton of debt in order to do acquisitions and really expand, and at the same time not really growing their assets as fast. And so they're sitting on roughly $131 billion of total liabilities, with just $6.1 billion in total equity. And so that gives you a debt to equity ratio close to 21 times. And so for a company like Oracle, considering the debt on their balance sheet is super important, and a figure like a debt to equity ratio really breaks that down for you. Companies like Meta and Google really doing well compared to an Oracle, even though they're all in that software as a service and business. Next up, we have the all-important free cash flow. So free cash flow is the cash a company generates by running the business and paying out all of its cash expenses. Something like depreciation on a property a company owns is not actually cash leaving the business. And so while that is a line item recognized for net income, it's not recognized for something like free cash flow. And free cash flow generally tells investors right away how stable a company is in paying its dividends, doing stock buybacks, or paying down its debts. And all of those things are cash expenses that are generally shareholder friendly. Now, one personal thing that I personally don't like about free cash flow is that we get to add back stock-based compensation to it. And so while that's not technically a cash expense directly leaving the business as a shareholder, that still impacts you in the form of dilution. And you generally see this with smaller companies more so than larger companies, as they display a strong free cash flow numbers. Even if their net income is negative, that's because they get to add back a ton of stock-based compensation, which ultimately dilutes you, the shareholder. Now, when looking to invest in companies, we want to see predictable and growing free cash flows while buying it at an attractive free cash flow yield. And so the free cash flow yield is essentially the free cash flow over the past 12 months divided by the market cap, or you could also calculate it by taking a look at the free cash flow per share and dividing that by the share price. And so let's take an example of PayPal Holdings, a company that, in my opinion, has pretty strong free cash flows. You can go to the financials tab on Seeking Alpha, go down to the statement of cash flows, and we get down to a line item saying free cash flow per share. In this case, over the last trailing 12 months, PayPal looking at roughly $3.83 in free cash flow per share. Again, this is just your free cash flow over the last trailing 12 months divided by the shares outstanding to get your free cash flow per share. And then to get a free cash flow yield, we take this $3.83 figure, divide that by the share price of right around $65, and we get to a yield of close to 5.9%. Now, in my opinion, this is a great yield considering you have your 10-year treasury, or your essentially risk-free rate, sitting somewhere between 4 to 5%, call it 4.5%. And so you're getting a free cash flow yield at the time that's greater than your risk-free return from the 10-year treasury. And that's really the thing that I like to compare the free cash flow yield against, because you can always go ahead and buy the 10-year treasury, get that risk-free rate of return. But you ideally, if you're investing in equities, you want to get a cash flow yield that's growing at a faster rate, and really that is at a higher rate than that risk-free rate of return. Now, the one thing we did mention with free cash flow is you want it to be predictable and growing. That's the one thing we don't have with PayPal. You see, back in 2014, this was looking at $1.42 in free cash flow per share, went up to $1.49, then up to $2.06, then down to $1.55 per share, then back up rapidly to $3.93. And so you have a back and forth, not extremely consistent and not growing in a predictable manner. That's the one thing you don't have with PayPal's cash flows, but that is something you have with a company like Salesforce. Again, a company with extremely strong cash flows that has been growing consistently. You take a look at this bar graph, rapidly growing in a very consistent and stable manner. And so you went up from $1.22 in free cash flow per share all the way up to $9.75 over the last trailing 12 months. With a company like Salesforce, you're only getting a 3.2% yield. So you're not looking at a yield nearly as high as PayPal's, but you are getting a free cash flow figure that's far more consistent and, in my opinion, far more predictable than a company like PayPal. And with a 3.2% free cash flow yield, that's not very far away from your risk-free rate of return. And considering that this yield will grow at a faster rate, yeah, that's something that likely you would pay for. And so understanding the free cash flow of a company, how it's growing, what its yield is super important, I think, for all investors. I think that is your benchmark to compare it against the risk-free rate of return. And ultimately, free cash flow is how a company returns cash to you, the shareholder. So that is, again, a super important metric, in my opinion. Next up, we have the price to earnings growth, otherwise known as the PEG ratio. And so the PEG ratio really tells us whether a company is undervalued or overvalued based on its current earnings multiple and accounting for its expected earnings growth in the future. How fast earnings grow is a really big part of a company's story, and we need some way to capture that. Now, because this number is based on the assumed growth rate, it could actually be different for everyone based on what they assume the earnings growth to really be. Generally, though, it's based on the consensus estimates made by analysts on Wall Street, and so a PEG ratio of 1 would really mean the company is fairly valued, that the price to earnings ratio, which we'll get into more later, is equal to the expected earnings growth for that company. Similarly, a PEG ratio of less than 1 could mean the company is undervalued, and a PEG ratio of more than 1 could mean the company is overvalued. Now, you could have a negative PEG ratio, which would basically indicate either the company is not profitable, meaning they have negative earnings, or that the earnings are expected to decline, which would mean they are expecting negative earnings growth. Now, with the PEG ratios, since it's based on future estimates, the key is to be conservative, as that's going to bake in a little bit of safety in your analysis. Now, let's take a look at 2 examples to analyze the PEG ratio. First up, we have Walgreens Boots Alliance, ticker symbol WBA. This is a company in 2024 trading at right around a 6 times price to earnings ratio, and so that is your numerator. That would be roughly 6 times, but you have to consider in 2024, Walgreens is a company that's expected to decline roughly 18% on their earnings, and so for that reason, they actually don't have a PEG ratio, and so right here you see NAN referring to not a number. And so for a company like this, trading relatively cheap at 6 times a price to earnings, that is for a reason though, because the earnings are expected to decline on a year-over-year basis. And so for that reason, I really like the PEG ratio simply because it considers the earnings growth into account. It doesn't really just take a look at the price to earnings, but also considers the earnings growth. Now, similarly, we can take a look at a company like Nvidia. Over the past year is up hundreds of percent, and one might say it's overvalued, but compared to its PEG ratio trading right above 1 times, you could actually make a pretty strong case that this company right now is fairly valued at nearly $900 a share, simply because their 2025, which is fiscal calendar year 2024, is trading at roughly 36 times a price to earnings multiple, but they're also expected to grow this year in 2025 at a similar 30-35% earnings growth rate. And so for that reason, trading at roughly a 1 times PEG ratio actually could be a case that Nvidia, even despite the fact that it's gone up hundreds of percent, could still be fairly valued near $900. So for that reason, PEG ratios are super important just to consider the earnings growth. Really, like I said before, the earnings growth of a company is extremely important, and there's a way we need to capture that. The PEG ratio does that beautifully. Last but not least, we have the price to earnings ratio, otherwise known as the PE ratio. You'll also hear this being referred to as the price to earnings multiple, or simply earnings multiple, and this is the most common and popular valuation metric. In fact, we use it all the time here in our videos, and pretty much in any other stock analysis, you'll hear them say the PE ratio. And so let's really break this down, what it means. Similar to how we have the price to sales ratio determining the value of every dollar of revenue, the price to earnings ratio determines the value of every dollar of profit. It tells us how much investors are willing to pay per $1 of earnings, and that's why you'll also hear the PE ratio referred to as the earnings multiple. If the price to earnings ratio is 20, what that means is you're paying 20 times for every $1 of profit. The price to earnings ratio is super useful because it allows us to just value a stock relative to itself in the past, or relative to other stocks in the same industry, or just relative to the overall market. And like most other metrics that we discussed, on its own, the price to earnings ratio really doesn't mean anything, and you have to compare it against another price to earnings ratio for a company in a similar industry. And for example, the long-term price to earnings ratio for the S&P 500 is 18 times, and companies that have a higher price to earnings than this 18 times, you can say, are trading at a more expensive valuation than the average market. And usually a company either won't have a PE because they're not making any money, or they just turned to profitability and their PE ratio will be extremely high because the denominator, in this case the earnings per share, is going to be extremely small. And so for that reason, sometimes you'll see younger companies have extremely high price to earnings ratios simply because their earnings are just turning to profitability and it's a really small number. Taking a look at Chipotle as an example for the price to earnings ratio, you can go on Seeking Alpha underneath the earnings estimates tab. The EPS estimates really over the next 5 to 6 years made by analysts are posted here, and so you can take a look at their forward price to earnings multiple for a company like Chipotle for this year, trading at right around a 53, call it 54 times a forward earnings multiple. That's based on an EPS figure, roughly $53 a share for this fiscal year ending in December. And like we said, 18 times is the average multiple for the S&P 500. And so from that perspective, you can say Chipotle trading pretty expensive compared to your average S&P 500 stock. But consider the fact that this company is expected to grow in that, call it 20% range. And so for a company that's growing faster than your average S&P company, might demand a slightly higher price to earnings multiple than your average S&P company as well. But like we said, you have to compare it to other companies in a similar industry. And so taking a look at the quick service business, really fast food, we can compare it against McDonald's, a Starbucks, and also take a look at Chipotle at the same time. And you see historically over the last year, Chipotle is generally the company that does trade at a much higher price to earnings multiple than your other two. But consider the fact that Chipotle also has faster growth than your other two fast food companies in McDonald's and Starbucks. And so the price to earnings ratio can give us a pretty good benchmark as to how a company trades relative to other companies in the same industry. Similarly, we can take a look at the price to earnings ratio of the financials, and namely the large banks in the US. And we have a JP Morgan, Bank of America, Wells Fargo, and a Citigroup, all trading right around a 12, call it somewhere between a 10 to 15 times a price to earnings multiple. The banks tend to generally trade around this multiple simply because they're not growing as fast, somewhere in the mid-single digit earnings growth over the long term, and they're also quite cyclical at times. And so for that reason, the banks tend to trade cheaper than the S&P 500. But the important thing is you can compare how the banks trade relative to each other. And you see over the past, call it 2 to 3 months, Citigroup trading at a much higher multiple compared to its peers, especially considering it's been trading at a much lower multiple over the past, call it 8 to 9 months. And that's large spike is likely due to the fact that profitability took a pretty big hit, considering they took a lot of one-time charges. And so anytime you have earnings take a big hit all at the same time, you'll see this spike in your price to earnings. And on the other hand, when you have your earnings go up rapidly, you'll see this spike down in your price to earnings multiple. And so that's something to keep in mind. Really, the price to earnings multiple is my favorite metric to compare companies in a similar industry against each other and also against themselves historically as to where they've generally traded in the past. Those were the 5 metrics I look at when thinking about whether to invest in a company or not. And now, by no means was this a comprehensive list, and there's a ton of information to look through when deciding where to put your money. And really that comes back to my first point, where you have to consider the qualitative and quantitative piece in your research. The valuation metrics is a great first place to start, just the fact that you get the knowledge of one part of the quantitative piece. Let me know your thoughts in the comment section below on these valuation metrics and additional things you find important when researching a company. If you stuck around to the end, hit that like button. A video like this takes a long time to put together, and so I would appreciate your support as always. Thanks so much for listening, and I'll see you guys in the next video.